Hello and welcome to this week's Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith this week. If you're new to the Market Outlook and you like to make sure that you receive it every week, please make sure that if you're watching it on YouTube, you subscribe to our channel, or if you're watching it on our website, you can subscribe to receive this every week for free in one of the input boxes on this page. This week, I think the focus was the jobs number for the market, and I think it should be. And I think it told us something that we haven't heard in a while. And that is typically when the market has come out with strong economic data, stronger than expected, which is what we saw with the jobs number, the stock's response has been to sell off in fear that the Fed would begin to taper sooner than the market would like. Now the stocks didn't do that. The stocks rallied. Short term, does that mean the stocks are bullish because news that had previously been bearish has now been responded to with bullish price action? On first blush, I would say yes. In addition, I'm starting with interest rates because interest rates did do what you'd expect them to do on the stronger than expected economic data. Interest rates went up. TLTs, the bonds, go down. That's the relationship. And I'm starting with TLTs this week because I think this chart is the clearest in terms of its most likely direction, both short-term and longer-term. Now, stocks in a lot of environments will be directly impacted or very closely correlated with interest rates, either positively or negatively, and we'll get to that in a second. Here's the interest rate story. If you've been watching Outlook for a while, this is a story that we've been consistent on for could be well over a year now. And here's the big picture. TLTs were extended up here. I know that's easy to say looking at the chart, but here's why. As they peaked, for whatever reason we won't need to go into right now, they sold off, took out their 200-day moving average, and when they tried to retrace, could not take out prior highs. The trend down from probably historic highs was now pretty obviously intact. The retracement back up to the 200-day moving average was rejected, as a downtrend would expect it to be, and a major top was put in place. The move down from the highs is pretty much characterized by this channel, which was blown right through. The market paused at what you would expect to be significant support, and more recently, as the market has rallied back up, taken out the 50, had a nice run, was unable to get back through that critical level, and that brings us to where we are today. Friday, yesterday, and I have this scrunched up for a reason, the market not only punctured back down below its 50-day moving average, but back down through a trend line from the low of this move, which happened to have formed a nice orderly channel, which implies really that the market had a really structured move higher, which represented a bearish flag in a much bigger trend down. That's why I go through the whole story. The big picture here is really clear. Now, that puts me in a situation of looking at this chart and saying probably the next objective is this zone down here where I've got a solid green line around the 95 level. Should be some pretty good support longer term, and if we really shoot down there quickly, this level in here, I think it's about a 96.5 level, is a likely support also. Do I think we're going to get there this week? No, but bigger picture here is interest rates are in a mode that is rising interest rates, which means lower prices on the TLT. Might they come back and rally back up? If I zoom in now, might they find a way to rally back up from this breakdown point? Yes, that would probably be a really nice entry point to look for another move lower. All right, so while we don't have to necessarily bank on the fact that interest rates are going up, if we see the interest rate environment as one in which interest rates are more likely to be going up than going down, how does that affect stocks overall? Well, if the economy is actually growing and it's bullish and the stock's reaction to positive economic news is positive, then higher interest rates really shouldn't be too much of a factor as long as they do it in an orderly way. Let's put that on the side burner for right now, and now just take a look at what's going on in the stocks. And I think you have to look at the stocks right now on a very specific time frame to figure out how you really feel. For me, I think the 3 to 5 day time frame is one focus, and longer than that is another focus, maybe 2 to 5 weeks. Let's take a look at the 3 to 5 day focus first. Okay, so here are the 4 major equity indexes on a daily basis. All right, the thing I want to focus your attention on first is that we've got 2 worlds going on here. First, we've got the Dow and the SPYs, which over the last several weeks have managed to hold up and more or less just consolidate. So here are the SPYs and here is the Dow. If we look at it shorter term, the last several weeks, they've just consolidated. However, they've consolidated with a couple of interesting patterns that have occurred. Key reversal, total engulfing, bearish engulfing pattern over here, another bearish engulfing pattern over here. Now typically you would say that is a pretty strong ceiling, and I'm going to say that. I think it is a pretty strong ceiling. The fact remains, however, that it's a ceiling for a very tight consolidation, and when those ceilings break, it can lead to a explosive move higher. How much higher? We'll get to that in a minute. The Dow also a really compelling bearish engulfing pattern. Now, just like the SPYs yesterday, these are both followed by up days, which now created an inside day in the SPYs. And when we get to the Qs, we're going to see an inside day there and an inside day in the IWMs too. All of this inside day action leads to consolidation, which if it breaks, you want to follow it in whichever way it breaks. Now, if we look at the Dow with a little bit more perspective, we see that the Dow not only has been consolidating the last couple of weeks, but it's been consolidating over a level that it's had trouble holding. All right, so it's managed to hold this level better than the last 2, or you could even say 3 times. Is that strength, or is it just setting up for a big drop? I would say either way. So if I just look at the SPYs and I just look at the Dow and I look at those 2 together, the situation is such that if we break higher with a 3 to 5 day perspective, we could see a nice run. If we break lower, we've got a lot of consolidation and it's ready to break lower. So 3 to 5 days could break either way. So which way should we favor? Which way do we think that it might go? Now, as a trader, I really don't want to have too much of an opinionated view when it comes to expectations, other than to recognize that when it starts to happen, it's in a situation where it could continue. I think the market could continue in these indexes in either direction that it moves, if it moves beyond their consolidation levels. So for the SPYs, if it takes out these multi-year highs, and same thing for the Dow. Downside, same thing. If it takes out the basically the low of Friday or Thursday, whichever is lowest, you want to be very careful. Actually, you want to expect more of a move to the downside. Let's take a look, though, at the Qs and the IWMs. Where the SPYs and the Dow have been consolidating, the Qs and the IWMs broke. And this is a reason why you might be more concerned about the downside on the 3 to 5 day window. So this Qs, you can see, had nice consolidation. They had similar negative price action, not quite as engulfing. But on Thursday, the Qs broke. They broke not only the consolidation, but they broke the green line here, which is the 10-day moving average. And the IWMs same thing. They've got two levels of consolidation. Thursday broke down again. Now you could argue that this magenta line being the 50-day moving average is support, but the picture here is that the IWMs have been leading in terms of telling you that the market needs a break. They've been the weakest. They're the broadest index. They've been weak. They continue to break down. As I said, both indexes have an inside day. Now, if the index has broken down and pulled back and you see an inside day after a pullback, that inside day actually could lead to be bullish if the market goes higher. All right, so sum that up. Qs have broken. If they continue to go lower after the inside day, they've got a consolidation that could push the market lower easily. Where's the likely support? Well, we've got a pretty nice move ahead of us if we go down to the 50 and this level of support down here around 79.80. If that were all to happen in one day, we'd be looking at a really nasty day, and I wouldn't want to be on the wrong side of that. For that reason, if the Qs start to break lower and take out their inside day lows, be careful. If the Qs break higher, you do have some consolidation here. You have an inside day, and the other two indexes we just talked about are in a situation where they could move higher. The problem with the Qs is they're going to have to take out their highs, but if we have a move up to those highs, it's going to look like a really nice day, and for the short-term trader, that's one to trade for sure. Same exact picture with the IWMs. However, the IWMs breaking above their inside day puts them back over the 10-day moving average and a little bit more of a move up to the high. So again, after a longer rest than the Qs, IWMs could see another move up to the high. If they break, they'll be breaking the 50-day moving average. Now, recently, when the IWMs have been breaking the 50-day moving average, they haven't stayed under there very long. The overall bullish trend is still intact, and the 50 seems to be very good support. So if the IWMs are down slightly below their 50-day moving average, and the Qs are at their 50-day moving average, from the bullish perspective, it's probably an interesting area to cover if you're short. That said, let's take a look at the IWMs trend line. There's an interesting trend line here, and I fudged it. What I mean by fudged is I basically looked at it on a closing basis, closing basis, closing basis, closing basis. The IWM's pullback here, which looks like it's to the 50, typically has not been enough to call it a correction. In other words, the last 1, 2, 3, 4 times before the IWM was finished correcting, it came down and pierced this trend line, which is below the 50-day moving average. So if you're looking for an area where the IWM might be done going down, it's probably down closer to just above 105. So a breakdown from 107 down to 105, again, a pretty nice move to the downside on the short term. And so for all these reasons, if we add all these up, all the markets are poised on a 3 to 5 day to have a nice move either way. I would not, but I'd follow the momentum either way. Now, that's just looking at price action. We also like to look at market breadth. Here are a couple of the indicators that we're typically looking at. So what you want to see in the market is, if you're bullish, if you're looking for a really good entry point on a pullback, you want to see the market have weakness. You want to buy on that weakness. If the market's strong, you don't want to be buying into an overbought situation, right? That pretty much goes without saying. So if we look at the market breadth in terms of overbought and oversold, and where are we within the overbought, oversold, one of the ways that we do that is with the McClellan. And if we look at the McClellan index here, and this is a ratio of advances and declines, we can see that when the McClellan index gets above this line and the market rolls over, it's an overbought situation and the market can tend to fall. Now, it doesn't always have to fall. If the market doesn't fall, but the McClellan is falling, it's telling us that internally the breadth is getting weaker and weaker. Now, you can interpret that two ways. In a market that's selling off, you'd interpret it as getting more and more oversold. In a market that's going sideways, you'd interpret it as internal weakness. And if the market breaks on internal weakness, it can lead to really nasty breaks. It means the market really has been weak, the indexes haven't really reflected it, and now that the price action is reflecting it, it can get pretty ugly, especially if you're not already very oversold. That said, if the internal breadth starts to turn up with strength in the market after consolidation, this weakness is telling you that the market has had enough of a rest. So again, this is just further evidence, as far as I can see, for the fact that the market has had a decent rest here. It's fought with trying to move higher, as we saw with the negative patterns. It has had a decent rest. If it moves higher, it's had somewhat of a rest in terms of the McClellan index. Is it washed out and oversold and a great buying opportunity for longer term? Absolutely not. Short term, has it rested and coiled? Yes, but it's weak. So a weak market is a good time to buy. If the price action has also been weak, it's a trader's buy if the price action hasn't really been weak. The price action hasn't really been weak, it's been consolidating. So look for this to move up if the price action moves up. And again, short term, from a McClellan point of view, we have had a rest. More of a rest than I actually thought we had looking at the price, just the price action alone. A couple of other indicators will confirm that. Now, these are also advanced decline indicators, so they are definitely correlated. But in terms of a 10-day sum, the 10-day sum is down below the level we like to see it to represent some overbought or oversold or weakness conditions. If this turns back up and the market turns up, it's confirming the same exact thing that the McClellan is saying, looking at it just from a different point of view. And if I take an even shorter point of view, the last 12 days we have the same thing. Now, but if we look at the volume, we haven't had a flush to the downside on volume. Now, that's obvious. Well, I should say that's not unexpected, given the fact that really the market hasn't had a chance to get flushed out on volume like it would after a decline like this, or a decline like this, or a decline like this. So I think this chart right here is a really good representation of the difference in the time perspective. Short-term consolidation set up for perhaps a pop, but weak if it starts to drop, and not oversold enough to suggest that we've flushed out all the bulls. We definitely have not flushed out all the bulls. In fact, let's take a quick look at the VIX for a sense of the sentiment to see just how fearful or not the market is. So if we look at the VIX here, we can see that the VIX index is as low basically as it's been all year. There is apparently no fear. Even with what looked like a pretty ugly day on Thursday, the VIX was almost unresponsive. What does that mean? There's not a whole lot of fear right now, and that again would lead me to believe that if the market decides to break out of this range on the upside, it's a dynamic situation, very short term, in 3 to 5 days, that could lead higher. Right? If you see the VIX starting to climb, if you see some fear coming into the market, that's when you tend to see the bigger drops start to happen. All right. That said, the market will probably have to go down for a couple days before the fear will start to build. No fear, I'd say that that leaves the market open for a surprise, but also open for a move higher. Okay, so if I add all that up, I see a market that's coiled, consolidated, 3 to 5 days, could really have a nice, over 3 to 5 days, could have a really nice move for the short-term trader in either direction. And with the inside day and the consolidation so clearly defined, those are your boundaries. But I can't leave you without giving you some perspective of the bigger picture. So if we take a look at the weekly charts, we're at some really interesting levels on 3 out of the 4 charts, actually 4 out of the 4 charts on a longer term basis. Now, I probably should start with the SPYs. So if you can see the chart, this goes back to the 09 lows. This is a valid trend line with a channel, parallel channel drawn. As you can see, it lines up very nicely and has done a really good job at demonstrating when on a weekly basis the SPYs have been stretched. Now the price action we just went over on the SPYs in the short term, on a weekly basis, it's really hard to say that the SPYs have negative price action, but they are at the top of the channel. But channels, look, everything I've said about a 3 to 5 day move would only puncture this channel a little bit. That doesn't take away from the fact that we're at the top end of the channel, and that makes it subject that if you look out 2 to 5 weeks or 1 to 2 months, it's not unrealistic to expect this market, the sell-off, the consolidation that we've seen over the last couple weeks is not enough to suggest that the market's ready for a major move higher without looking for some kind of a very unusual push and acceleration higher. Now, if we take a look at the IWM, I think it's even more interesting because it's the same channel, but for the first time, we're back up to the top side of this channel. And if I were to move this line down to encompass this high here, we've definitely moved high enough to see the top end of this channel being a good area for it to stop. If we look at the weekly patterns, we've got a key reversal on a weekly basis that this week we were not able to reverse. So again, IWM's weakest, and on a weekly basis look like potential they may have already started, and new highs for IWMs are going to be more challenging than perhaps the daily chart suggests. That leaves us with the Qs. The Qs, I have 2 lines here. The white line is the line that I've been drawing on the other charts. Essentially, the trend line from the the valid trend line from the 2009 low area with a parallel. If we draw the white line with the valid trend line, we're not there yet. However, if the yellow line takes it from the actual low, fudges the lines a little. So the yellow line is meant to really represent an area, not precise levels. And you can see the yellow line parallel is the dashed line here. And doing it that way, the Qs are extended enough. Now, I'm not doing this just to fit it in. I'm drawing the lines to try and represent broad areas where the market could find its highs and its lows. That's why I'm not saying this perspective is telling me what's going to happen the coming week. It's over the several weeks, maybe even the next couple months through the end of the year. the market is extended. It doesn't seem to be afraid of anything right now measured by the VIX. It's weak enough and consolidated enough on a daily basis to put in another trader's push higher. Okay, but if you're looking for a great longer term buying opportunity, looking out over several weeks or several months, you're going to have to be very selective on individual stocks. The overall indexes are not very supportive of it. If we take a look at the diamonds or the Dow, as our final chart, this was the line I was looking at on the daily basis. You could argue that we're breaking out of a pretty nice consolidation, or you could argue we're just at the top of a channel. So, depends on your perspective. The market's definitely coiled for a short-term pop in either direction, but I think if you look at the longer-term picture, if that pop or that move is on the downside, the longer-term picture suggests that more of a move on the downside is needed in order for the market to really digest and have a major move to the upside. Doesn't mean we have to crash, just means it depends on your time frame and the perspective you want to play it. Hope that helps, and I'll see you in the next video.